welcome to the show.
Lenny, thank you. Thank you for having me.
For sure, my pleasure. So, I know you have a really diverse background and really just want to, understand your experience, solely when it comes to the clients that you're working with in Latin America. Really want to understand, how does the financial landscape differ between Latin America, the US, and Europe?
Well, it's vastly different because of the perception and the priorities, let's say, of the different clients. So in the US, everything is transparent in a way that you give out your social security number to your banker and to your bank, and everybody has it, and no problem, and they see everything. And it's not, I'm not going to say it's public, but it's you have no issues with your privacy and your secrecy. In Latin America, in most countries in Latin America, I would venture to say that it's life-threatening to put how much money you have in banks out there, because you become a target. You become a target for extortion. You become a target for kidnapping. Remember that Latin America in general, and there's countries that are more than others, the rule of law varies from country to country. So the protection you might have from extortionists or from kidnappers or from basically people that just want to do harm to you and get your wealth varies, and it's extensive. I mean, the different things that happen in Latin America are just incredible, and it's a country by country thing too. That also gives you an idea, to give you an idea of the different types of clients we deal here at Klosters. We deal with Mexican clients, with Venezuelan clients that are no longer living in Venezuela, so they are probably in Central America, in Panama maybe, or they are in one of the islands, or they are in another country like, let's say, Argentina. So we have Argentinian clients, we have Chilean clients, and each country has a different way of perceiving wealth management and how they do it. But in general, the wealth management community of clients in Latin America are very protective of their information and of their wealth, meaning it is very hard for them to give you more information aside from what you ask them. So if you're Morgan Stanley that asks them about information about their holdings, they're going to give you a very limited vision of what they have. Same goes for any other bank that asks for. So generally, the approach that we have at Klosters, as you know, is different. It's we try to see the whole picture. So we try to see what they have at Morgan Stanley, at Citibank, at JP Morgan, or at 𝘱𝘰𝘯𝘵 in Geneva, or Vontobel in Zurich. I mean, it just varies, right? So but we try to see the whole picture, and that's another characteristic of Latin American clients. They're multi-jurisdictional, so they have accounts and custody in the US. Sometimes in their home country they have something, but mostly it's the US, and they're dollar-centric. They think in dollars. They don't think in euros, for instance, mostly.
And so
they might be. So sorry, go ahead.
No, just to jump in here for a second. So, with those, kind of locked doors, essentially, I guess you can look at it as, how do you overcome, kind of those unique challenges when really trying to dig in and help these clients?
Well, the fact that we're in a, let's say, in a safe jurisdiction, most of them consider the US to be a safe jurisdiction. Even there's some jurisdictions and some people in jurisdictions that think that the United States, they'd rather not be here because they might be exposed to US taxes. If the advisor doesn't do things correctly, they might expose them to US taxes, especially estate taxes. So that's something that happens very often, by the way. That you see clients that have portfolios of stocks, direct stocks, Apple Computer, for instance, Apple Inc., or they have stocks of, or they have real estate holdings, and they have it in their own name, and they have with that, they have huge exposure to estate taxes because as you know, the exemption for estate tax for U.S. persons married, around $23-25 million, something like that. It's going to change in the future, but that's more or less a number. For non-U.S. persons, the exemption is $68,000. So it's for them, it's like there were no exemptions. So they will be exposed almost completely to their holdings if they're not structured correctly to hold those assets in the U.S. Through it might be an offshore company, It might be through an LLC that's also owned by an offshore company. There are several avenues. We don't give legal advice, but we've seen it all. Trusts in New Zealand, to trust in Canada, to trust in basically here in anywhere in the States that the lawyers recommend. But it's basically the idea is that they try to protect their assets and try to protect not only from prying eyes in their own countries. So they try not to share this information. They try not to have the advisor in country. They have to have it outside the country. So that gives us an edge being in Miami, outside the US. And also we have access. It's becoming easier, but it used to be very difficult to deal with Switzerland from the US. So now some banks allow it, given the fact that these clients are not US, obviously they're non-US clients. But it's also a way to deal with through us in the same time zone as they are, mainly we plus or minus 2 hours. You have the same time zone. You don't have to deal with a Swiss banker that right now is probably sleeping. So because it's 2:00 in the afternoon here in Miami and in their home country in Latin America. So generally those are the main differences. The Europeans have a different mindset and have different sets of rules. We opened an office in Madrid to deal with it, which is a separate, let's call it cousin company in Madrid and in Spain in particular, fully registered with the Spanish authorities, because it deals with Europeans and how they are structured and how they where they can invest, which jurisdictions they can go to. But so that's a different thing. And US, like we talked in the beginning of this conversation, the US is basically like, you know what, they are basically they can open an account. Generally, they don't do it through a structure unless it's a very wealthy family that it's structured previously through trusts or other such mechanisms that allows them to protect them.
Gotcha.
Protect their family. But it's not for secrecy. It's mostly for protection of and tax awareness of the American client.
And so with that being said, I think that'll be kind of a good transition into the topic here. I hear a lot of different things. I think the one hot topic is the Rockefeller's waterfall method, and then you hear premium financing for life insurance and life insurance in general. Of utilizing these different strategies through trusts and to protect wealth or even grow the wealth. So can you kind of just break it down and explain, what are these benefits and also maybe even parlay into, some high level, real life examples that you're maybe currently working on as well?
Sure. Yeah, I mean, that's something aside from what we do at Klosters Capital, which is we do a consolidated wealth management. We see the whole picture of all your banks throughout the world, wherever they are, for our Latin American and US clients here. And also we do this in parallel in Madrid for our clients. We offer them the idea of life insurance as a tool and as a very important part for basically several reasons. One of the main reasons is to give the family liquidity. Most of these families that we deal with, if you want to go back to the profile of a typical Latin American investor, ultra high net worth, are generally business owners or business owners that have recently had a liquidity event, sold their companies, but mostly business owners that have been living third, fourth, fifth generation of business owners that have been living of their business in their countries, and they have expanded to other countries as well. That's a very typical thing to see within Latin America. And they want to hold their assets in the US. So they have custody of their assets in different banks here. There's some liquidity, meaning they have some assets that are basically liquid, like stocks and bonds that they can liquidate.
And what are, just to stop for a second, Erik, what are these families typically worth? Just so we can throw like numbers here and what they're kind of usually.
They're in the hundreds of millions to billions, to several billions. I would say the richest family, there's the Slim family, which is very famous in Mexico, Carlos Slim and Company. They have several $1 billion in net worth. Gotcha. And there are several families, and many families you don't know about, because again, the point here is they don't want anybody to know how much they have. Right? So it's very rare that you actually find out how much a family is actually worth in Latin America, because they don't want you to know. They don't want. They're exposed to so many risks in their own home country that they don't want to share.
Understood.
So, but generally, if we're talking, the life insurance component, or let's go back a second. The custody of the assets is generally a small percentage of what they're really worth. So let's say somebody has, typical case for us, we have a family that owns businesses in several countries in Latin America. They have in total with us like $110 million. I would say that's around 20% of their total worth, right?
Gotcha.
That's there. So, and it's already held in hedge funds and in stocks and bonds and ETFs, all the good stuff that we put into their portfolios, and the banks work with us in finding the best products for them. That's great, but they have a huge problem when they die. They have a huge, they might have a huge liability at home, because most of these countries have estate tax as well, at home or here in the States, depending on how they're structured, for estate tax purposes. And not only for estate tax purposes to pay the taxes within 6 months or 9 months, whatever the jurisdiction says it has to be paid in, but also to, what is your wife going to be living off in the next month if you die today? Like, where's she going to go? You always give her cash every month so she can cover all her needs and travels and whatever she needs to do with her, and take care of the kids and the schools and all that stuff. Who's going to take care of that? So life insurance comes in as a recourse, because generally it gets paid within a week of showing the death certificate of the policyholder of whoever was insured. The beneficiaries will get the check within a week. And it has also the benefit that in most jurisdictions, if not all, I think it's mostly in Latin America, all of them, the payment from a life insurance company from a life insurance to the beneficiaries is a tax-free event. So they don't have to pay taxes or estate taxes or anything in related to that. It's just a check that comes in, and then you start using the cash right away. So that also is an attractive feature of, it gives you instant liquidity, let's say, for your heirs and for your business or whatever you need it to do. Then we can go as deep, and I don't think we should go into that as here, but buy-sell agreements that you have with your partners in the business, that they don't want your wife and your kids who are in high school owning a portion of your company, because they don't know what they're doing generally, as you did as a partner. So if they're well structured, they should have buy-sell agreements in place, but it has to be paid with something, right? So instead of having the widow liquidate portfolios in order to get the cash to pay off the partners, or vice versa, or receive the payment, these life insurance policies help everybody get settled if it's relatively well planned. It provides liquidity that wasn't there. It also enhances the net worth of the client at the end of his life, which is also a great thing. We've actually done it for clients that I've seen that happen. Clients that have had in some jurisdictions in Latin America have had their factories or their businesses taken away from them by the government, expropriated without payment. So basically stolen. They come here to the States with them. They have a huge portfolio here, it might be in the hundreds of millions of dollars, but they took away $500 million worth of business in their home country. How do you build that back? Well, life insurance is a tool, because the way we work life insurance, we can actually get policies that, the biggest one I've seen is around $200 million in coverage for a family, and that allows them to rebuild for their heirs. Like if you wanted to leave your kids the $500 million business and now it's gone, you still have some assets here, and the insurance company will say that's we can actually insure you for another $200 million if you have 100. No problem. That's generally the case, and they will do that, and you will enhance your net worth for your heirs when you pass away. That a big problem with life insurance, I would say, here, the perception of life insurance here in the States and also all over the world is, you're preparing for death, and death comes into it. And all our clients in general, and all the clients I've seen throughout my career in 30 years, they are always thinking, if I die, and they should be thinking, when I die. There's a big difference between if and when, right? So it's not if, sir, it's you're gonna die. Right. So let's get prepared. So if you talk to them, they're always talking, if I die, I want that to go to my son. If I die, you're gonna die. So it's not an option.
Yeah.
So, but you getting over that hurdle, and few of them do initially. Another thing they're not used to is the idea of life insurance. They think it's for somebody else's. They think it's for an employee that has life insurance to take care of his wife and kids and put them through college. But for ultra high net worth individual has huge advantages. As you said, the Rockefellers have been using life insurance as a tool to enhance their wealth through this waterfall mechanism. And what's the name of the Waltons also from Walmart? I understand that they have the same structure. I'm not sure, but I'm pretty sure that they have it. The
And how
same
does that
structure,
work?
which is
Can you explain that, like, conceptually,
it's
like, or,
yeah,
high
you
level?
insure everybody. You insure everybody. The kids, everybody's insurable because they own part of the business. So in order to have life insurance, you have to have some sort of connection to wealth. You're not going you and I, let's say somebody makes $1 million, $100,000 a year. You're going to go in and say, I want insurance for $100 million because you're not worth 100. The insurance
Right.
company is never going to insure you, right? But a Walton family member, you can insure him or her, even when they're younger, which is cheaper, by the way. The older you get, and it's exponential. So the older you get, the more expensive it becomes to insure you because you're closer to the inevitable event.
The end of time. Yeah.
Yeah. So what they do, and that the waterfall that you mentioned, the structure is it all flows into a trust. So it's held in a dynasty trust. That's basically a forever trust, if you want to. It could be set up as a forever trust. But all these people are insured, and as they pass away, that insurance coverage goes into the family trust, enhances the family's wealth, and is shared accordingly. According to the structure in the trust, it will obviously go to the family of that person first, but it also enhances the wealth of everybody else. And everybody does it at the same time. And these are, through time, hundreds and hundreds of policies that have flowed into a trust, right? Or trusts. So that's a great way to do it as well. In fact, when we set up trust for insurance policies for our clients, it has to be under either an existing trust or a life insurance, irrevocable life insurance trust, which is the right way to hold it, right? Another feature that people, Latin Americans in general, are weary of, the offshore tax paradises and all this stuff, because they've seen the scams, they've seen the problems with these jurisdictions. So they want to be insured with U.S. companies. Through us, we have access to several of the best U.S.-based companies. And as you probably know, in the U.S., there hasn't been a case in which a life insurance company has not paid a claim legally. I mean, there's fraud in everything, everybody, always. But legally, they have always honored the payments. And generally, when life insurance are super regulated by the states and at the federal level, but mostly by the states, so they never let them go down. They always, other life insurance companies will buy the portfolios of policies from other life insurance companies that are not doing so well in order to give them the liquidity or whatever. So that always ends up protecting. I think it's been 180 years since a company has had no issue here in the States. So the United States has a good record of, honoring.
So with
that.
I just because you said something interesting. You said the offshore risk scams that have gone on. Can you explain that? Like, what do those look like typically?
Well, one of the most that it's hit some Americans as well, but mostly in Latin America. If you remember back 10, 15 years ago, Stanford Bank, of this guy, Stanford, he's an American, but he set up a bank in Antigua in the middle of the Caribbean, and the bank grew dramatically. He was offering, when everybody else and his cousin was offering 2.5%, 3% rates on CDs, he was offering 8% on CDs. Everybody flocked. And he had the most green and silver and gold splattered all over their brochures, beautiful brochures. If you were, $1 million CD investor, they took you to Antigua and, showed you Mr. Stanford's home. And Antigua was a small, tiny island that in the middle of the Caribbean. So that kind of, and it ended up costing billions of dollars to the investors. Smart people that I know, smart people, meaning to people with PhDs in economics, and say, how can you be paying 8% on a CD where everybody else is paying 2%? He must be doing something different, right? No, he's great. He guarantees that. Yeah. So people are greedy by nature. That's no matter what. But these types of jurisdictions, actually, once again, the US is a much better jurisdiction, to put it positively. The US is a better regulated and better there's a lot of good oversight in these industries here in the States, more than anywhere else.
Gotcha.
So that's why they like life insurance done here in the States.
And
also the capacity, right? So if $200 million with Bermuda has a lot of life insurance products and companies there, which are perfectly fine. But they don't have the capacity to insure anybody for $200 million on their own. They don't have the balance sheet. Gotcha. Whereas if you do a syndicate of 2 or 3 companies here in the States, you're gonna definitely get the coverage you're looking for really big families.
Yeah, sounds like just the ability to have more options here.
Sure.
So in terms of premium financing for life insurance, I don't know if you went into that yet. I think when we initially
no, we just talked about the let's say the concepts of life insurance.
So why don't we talk about that a little bit? Sure.
So life insurance, let's say simple number, let's say $10 million policy. A $10 million policy for a 50-year-old should cost, if it's, again, let's go back. There's 2 types of life insurance: term insurance and whole life insurance. So term insurance is like your car insurance, meaning you stop paying your car insurance, your car is no longer insured. Same with term insurance. Term insurance, you don't pay that month's or that quarter's or that year's premium, you're no longer insured. And it's only for a period of time, so for 10 years. The thing with life insurance is that if I took out a term life insurance for the next 10 years for me, when I'm 66, that will end. So if I die at 66 and a day, nobody's going to get any money from my family. That policy is over, it's done for. Whole life insurance is another matter. Whole life insurance has an investment component within the structure of the policy, meaning the money grows within the policy, tax-free or tax-deferred, inside the policy as a cash value, let's call it. And that cash value grows in time, depending on how it's invested by the insurance company itself. Some companies put it in their own main account that invests in real estate, and these insurance companies have billions of dollars in commercial real estate, for instance, or bond portfolios, and billions of dollars. So you participate in that income, and that makes your cash value of your policy grow. So when you make a payment to a whole life insurance policy, you're paying for the premium, as the portion that actually covers for your life if you die the next day. And there's also a component that also goes to investment, that cash value. That cash value will grow, and depending on the life insurance policy, it will grow faster or slower, depending on what's underneath, what's the underlying assets that the company invests that cash into. So that premium has to come out of somewhere. So generally, if, again, to the example of a $10 million policy for a 50-year-old, it would be like $300,000 a year in premiums, just to keep that policy going for the next 25 years. So that's a lot of money for anybody at 50-year-olds just for $10 million coverage. So for 25 years, you pay $300,000 a year. That's a lot of money. And then health is an issue too. So different levels of health. So they have from the super premium to the standard to the substandard, and depends on the company wants to take you as a client or not. But generally, health also influences the amount of premium you have to pay every year. So once the example, $10 million, 50-year-old, $250,000, let's say. If he had to out of pocket, you have to have $250,000 to pay your life insurance, or your policy will, within a couple of years, will just basically die out, right? And nobody's going to give you back the money that you paid there in cash value, as it's consumed by the premiums that need to be taken out. So premium financing works by allowing the client, and it generally works well for our clients, because most of our clients are over their 50-year line, which is where premiums go exponential, 50, 60, 70. We've insured people up to 72, 75 years old, depending on if it's a woman or a man. Also, there's a difference, by the way. Women are 7 years younger in general than men when you calculate the amount of money they cost, because they live longer. So up to 75 years, you can insure anybody in good health with premium financing. How do we do that? So we get a bank to loan you the money So you pay off the premiums directly to the insurance company. They go and pay the premiums directly. You're only, and they usually not, it's a great asset for the banks. It's a great business because they're the cash value of most life insurance products is a very, very good asset to invest into or take as a collateral by a bank loaning you money. That's generally a premium type of asset. So they lend up to 95%, some banks even 100% of the cash value. So there might be a little bit that you have to put up in collateral, meaning if you have a 𝘰𝘰𝘯𝘵𝘠𝘭𝘕 Chase account, you put a little bit, let's say it's $300,000, and they're loaning you 250. The 50,000 you have to put up in collateral, and that's your money, but collateralizing a loan. So the bank takes care of that, and you only pay for the interest to the bank. So instead of paying $300,000, you're going to pay like $20,000, depending on the interest rate. But let's put that number, $20,000, a much smaller amount of money every year. As this happens, and it's a difficult concept to grasp, every year that we do the same thing and repeat and repeat and repeat, the cash value of policy grows that year. And generally, we choose products that are structured in a way internally that have a floor and a cap. So most of the products that we use have for instance, the S&P 500 as an underlying guide, right? So the S&P that year, when you took out the policy, went up 20%, you get capped at 11. I think it's the cap right now in most companies. So 11%. If it goes down 20%, you make zero, meaning the cash value remains the same. So you never lose money on your cash value as it grows. So 1 year might be negative, which is very common, but 1 year is going to be positive. So you take advantage of that, and when you average that out, it's around 6-7% a year, growing as a mass of money that's in your cash value, in your policy, growing tax deferred. As it grows, there's a point in time in which the arbitrage between what you're paying for the the loan and your cash value makes sense. And right now, it's also a good time to basically use the cash value at some point in time in the future, within year 8 or year 9 or year 10 of the policy, depending on the age, depending on several factors. But let's say year 10, you have enough cash value to pay off the loan and keep the policy going forever and ever until you're 100. Doesn't really matter. The cash value takes care of the loan. So you might have a case, which is generally our case, in which at year 10, the policy has been paid through loans, and then year 10, you have enough cash value. You take out a loan, which is a key part, from your cash value at a much smaller rate. In our cases, for our clients, it's around 4.5%, 4% flat, and that's also a benefit. And it's a non-recourse loan, meaning that you never had to pay it. But basically, in practical terms, you take it out as a loan, so there's no tax implication. You pay off the other loan from the bank that you took, and you're done. The policy goes on forever and ever. And the difference in cost is generally between 8-to-1 or 12-to-1 or 15-to-1, depending on the age, of how much it would cost if you actually were going to insure yourself, paying every year the amount of premium, or instead of that, just out of pocket, pay the interest on the loan. So the huge differential is what makes sense to most clients, and most of our clients are older. Sorry.
No, I had a question that came to mind here. So when you pay off that initial loan, the first one with the 4% loan, so what happened to the 300,000 a year that you have to pay for the premium? That's been already paid off and taken care of?
There's in that component of the $300,000, the strategy states that we overpay the policy. We try to overpay as much as we can.
Got you. Okay.
Insurance, and so we overpay as much as possible, and possible is IRS possible. Right. The IRS has a if not, you and I will be investing only in life insurance and put all the money there, and then borrow against it, and it grows tax deferred forever. So the IRS came up with some rules, and it says, so for instance, for this $300,000 person that needs to pay $300,000 if you were to do it every year, we probably get up to $800,000 that year in a loan. That $800,000 guarantees that the cash is going to grow much faster. It's a lot more money coming into the cash value or the cash portion of the policy to grow faster, right? So, and that allows it to grow. So we probably get 6 loans in a 10-year period of $800,000 each, and it's always calculated to the basically to the within the point where it no longer becomes an insurance product, and then you don't want that to happen. It becomes a modified endowment contract, as they call it, a MEC.
So
you don't want that to
front
happen.
loading. So essentially you're front loading these payments, and then when
Correct.
it comes time to cut it off, you've
Correct.
front loaded it so much where you don't have to make the payments anymore, or forever.
Correct.
Okay.
That's it. Exactly right. So you're front loading it, overpaying as much as possible as allowed by basically by the IRS. And it's all done in concert with the insurance company and with the banks, right? And the banks that we work with like 18 banks, and they all know the product, they know how it works. They know it's a beautiful risk, right? It's fantastic for them. It's if the person dies, we get paid by the life insurance policy, because you get that you in the benefits, the first beneficiary is the bank, and then is your family to the amount you want it to be, right? So generally everybody gets paid in the end. If you die the next day, everybody gets paid and everything works. If you pay off the loan, fantastic, and the policy keeps growing. Another way that we use this type of mechanism for our clients, which is very common, as you know, have you seen it? I mean, liquidity events. So let's say he has a $800,000 a year. So let's say he has $5 million in loans each year that have paid off his policy. He has a private equity fund that's, he's going to get the final payout, which is going to be $5 million. So instead of keeping that money in cash, he uses that to pay the loan and keeps the cash value in the policy. So what happens then? You have a huge cash value in the policy that's still growing every year with a floor of 0 and a cap of, let's say, 11, 12. It grows, and depending on the insurance company, but it's around there, which is a beautiful investment because it's tax deferred versus what you have everywhere else. And then you can convert that into annuity payments going forward. So let's say at year 70, when I'm 70 years old, I want to get a $1 million annuity from my cash value, and my beneficiaries will also get the policy, the insured amount when I die. So that's also a way to do it. So instead of paying it off from the cash value, which is the usual alternative, you can pay it off from a liquidity event, a sale of a home, a sale of a business, a sale of, again, a private equity fund that redeems to your investment and gives it back to you. And it's perfectly fine. So this example of $10 million, $800,000, etc., can be taken to 20, 30, 40, 50. Typical Latin American client will take out $25, $30 million in life insurance, depending on their age, again, age, health. But we've seen it up to 71 for men, 74, 75 for women, which is incredibly expensive if you were to do it out of pocket. But financing it reduces the cost dramatically for the out of pocket cost, at least.
So what are some of the common objections that clients have about the premium financing, and and what are some ways that you kind of address that?
Well, I wouldn't say objection. I would say that once they get it, getting to the point where they actually get it, and we show them through graphs and charts and Excel spreadsheets, which is not an easy way to show, but it's the only way to get into their heads. Yeah. So I hope this explanation verbally has shed some light, but still people are going, great. What? I really don't get it. But yeah, so I don't have to pay anything. I don't have to pay the loan back. No, the life insurance will take care of that. No, so I don't have to. No, you only pay for the interest. So getting them to that point where they get it, and then their eyes go like this, and you see the sparkle, and say, "Wow, this is a beautiful investment," because it's a small amount of cash that I have to put out every year compared to what I'm going to get back from the life insurance policy, right? So once they get it, I will get. It's not an objection. Is that point in where they click and say, "Wow, I got it." And sometimes, and it's a very quick process, and it's very quick process, meaning once they get it, we just say, okay, let's get you some exams done, and they have to be done in the US. So they have to fly to the US, or if they're here, they have to be in the US. These US companies demand that it's in the US, makes sense. They do their basically, depending on the size, an EKG, they can come to your office, you can go to them, they can come to your hotel room if you're visiting, doesn't matter. They do a urine, blood, EKG, and that goes out, and then all your doctors' files also go out to them. They sign HIPAA forms, obviously protecting their privacy, et cetera, et cetera. And that process takes about between them, depending on how fast it is to communicate with the doctors in Latin America and how complicated the health issues are for that person. But generally, it takes about a month, and then another month to get the banks. Once that's done, and that it's an insurable person, which that's the first step. You have to know if you're insurable or not.
Right.
If you're insurable, great. So we'll get quotes, blind quotes from different carriers that we work with, the top 10, let's say, in the US, who also have the best product inside. There's not only it's a mix, right? So it's not only the carrier that has a great reputation, a great rating. The carrier has to have the best product that's going to capture value in the cash value. If it's a product that's going to yield you 1-2% because it's tied to their bond portfolio, it's not going to be a very efficient product to work with, right? But if they have something related to stocks but with a good floor and a good cap, then it makes sense for us. So it's choosing the right one, and then you go about and get a quote from each one, and then a blind quote, meaning we have this subject. We don't, because in the States the system is set up that they all share that information is out there with a person within the insurance companies, right? Just to avoid people getting multiple insurances with different people and they don't tell anybody else. So they have 10 life insurance policies worth $10 million.
Right.
They just so they know what they're doing.
So what are some of are there any competing alternative products to this concept that's in the marketplace as well?
This is not a new concept. I mean, it was new 25 years ago. It was, let's say, the first premium finance products, like I'm describing them, were issued 25 years ago. And since then, some life insurance companies have shunned them in a sense that they're not interested in that market. They're more retail.
Right.
And some life insurance companies love it because of the great value they bring to the company with one single client. It's like in my business, I'd rather have, one $20 million client than 20 $1 million clients.
Right.
To deal with and on the paperwork and just basically bandwidth
administrative
level, right?
Yeah.
Correct. So some life insurance companies have taken to heart this type of product and they love it. And the banks also, big banks and not so big banks. There's some companies there's some banks that actually lend only to life insurance. That's their business. That's their business model. They were created they just to lend to these type of products. So I would say that the competition is with other companies that also offer the premium finance, that have the backing of these good life insurance companies, and not all of them do. And I've heard pitches from many of them, right? And some are good, some are not that good. Some are like the strategy is different. You want to be with an experienced group. The group that here at Klosters, we're a small firm. We manage over $700 million, close to $1 billion if you add the assets on our advisements, not including the life insurance. That cannot be included because the SEC will kill us. That's not a part of our business, right? It's just an ancillary part of product that we give to our clients. So there's 5 people here. That's it. So we don't have we joined forces with another company here in Miami that personally I've known them for 20 plus years. Here in Miami, they only do this all day long. That's all they do. They do like $1 billion in coverage a year, which is a lot. So they do like $1 billion in coverage only to Latin American clients. So they know the clients, they know the banks, they know the insurance companies, and they take care of all the underwriting, which is a big part of the process, going through the process that usually takes between super quick, 2 months, super slow, 6 months to a year, depending on different pieces that need to be fit together in order for it to happen. But generally, that's the time frame it takes. But once it's done, it's locked in. But when I say it's locked in, that's another key piece. I don't know if you've ever bought life insurance. I bought life insurance several times, term life insurance, most of my life. Once you buy it, you'll never, ever hear from the agent again that sold you the policy. No way, not even a Christmas card, nothing. You'll never get near, because he got his commission, he's gone. This type of product requires, it's a bespoke type of product. So it's made for you specifically because of your needs and your expectations and the liquidity that you're having or not having, or the type of what you want for the product to be for you. So it's very personal. And it's very flexible. So it's not set, it's set in stone, meaning that you're covered, no doubt, but the conditions of the policy as the cash value grows, going to the cash value each year, there might be a point in which you decide you have another whole life insurance policy. You can transfer that cash value into this policy's cash value because it grows faster than the other one. We can actually do that for you too. It's like that transfer, and has no tax consequences. It's not equivalent, but it's similar to a 1031 exchange type deal with but it's in the insurance type, and in the insurance cash value, you can transfer it from one company to the other and put it to work in this particular policy, enhancing that particular strategy. You can do that, but in essence, it's as interest rates fluctuate, because one of the objections could be, as you ask for objection, well, the interest rates are super high right now. Well, we don't know what they're going to be in the future. Maybe this is a new floor, and from here in 10 years, going to say, why didn't I take that policy now, then which is at 6.5% instead of 9%? Because we don't know, right? So and you have to remember, as the interest rates go up, all assets returns generally go up as well, and the volatility expands, et cetera, et cetera. That's another issue. But it allows us to, if let's say in year 3 we find a bank that's basically saying, listen, I'm going to give you just a 30 basis point spread on so forth, and we find that bank, hey, we got a loan, so that year we're going to take that loan from that bank and maybe refinance the whole deal that we had before. So it takes somebody to be on top.
So it's a living, breathing process. It's not like one and done and then
correct.
Gotcha.
And you're out, which is like the experience everybody has that's why everybody has life insurance salesmen, because they're like they love you, and then when you sign and you pay the premiums, they're gone. This is an ongoing thing. So the company that we partner with, it's a family-owned company in which the dad and his 2 adult sons and daughters manage a group of 20 people under them, plus another group that does the underwriting as well. So it's a big group that when dad retires, the kids are going to take over the business, and they're very qualified, they're very smart, and they have a very defined role within the company. So we love that. We can show it to them. They're younger than me. They're probably between you and me in age, and they can take over and keep going. You only need to be there for the next 10 years, let's say, until the loan is paid off, because that you need somebody to do that for you. The client cannot go and say, well, I want to pay off the loan. No, there has to be somebody that knows the whole process from the beginning that can take over and pay, and at that point say, okay, pay off the loan, done. So yeah, again, another advantage, and something if you're looking for somebody to do this for you, you need somebody with experience. We have 25 years of these guys doing it since the very beginning when the product was initially launched by some insurance companies in the States. And it's the only thing they do. So again, something that the Latin Americans in general appreciate of the United States is that this is the country of specialization, right? So you want a hand surgeon, you want the right-hand guy or the left-hand guy? Because we have 10 of these and 10 of these. You don't want the right-hand guy touching your left hand, right? So you want the guy specialized. So we work with specialists that only know this and know it, through and through. And that's probably a key element to why we're successful. If once we get over the hump of the client understanding how this works and saying, this cannot be real, this is too good to be true. And when they say, this is too good to be true, but it's actually working and this is how it works, it's all downhill from there. Yeah, correct.
No, that's good. This is good information. I think I really think you did a good job explaining it. So
hope so.
Kudos.
Lots of practice.
No, it's good. And so I do have a couple questions, set questions here for the Family Office Fire 5 round that I do for each guest that I'd like to shoot off to you and get your thoughts. So, what's kind of a common misconception about your field of expertise that you'd like to debunk?
Well, regarding what we do, generally the perception of an investment advisor is somebody that's trying to help you, but is going to charge you a ton of money and is not aware of costs. They're just there for the money. They're just there to feed their family and pay their mortgages, but it's the only way I can get access to these custodians. Our approach is different. We all take care of your costs. We look for costs as much as we look for return. We're look out for costs and not paying costs that we don't have to pay, as much as a better return and a more stable return for the portfolios of our clients. On the life insurance side, I would say that the misconception, as I stated before, is basically we're selling death, and we're we're related to death, so it's stay away from that guy. We try to use the life insurance as a tool to help our clients. And once you say this, and we had recently a client that typical case, family, 3 sons, 4 sons, 2 daughters. One of them is a surfer, the other one is in the arts, the other one is none of them are in the business of the dad. And the dad wants to leave everything to them, so they take over the business. And the dad has very specific, long-held favorites in charitable contributions. So different type of causes that he loves. His kids don't give 2 damns about the causes. They have not been involved in it. So when the dad dies, they're going to get the money, and the causes are going to get 0. The dad knows this. How to solve the problem? Get out life insurance for dad, for his life insurance that benefits the kids, and also goes to the charities that he wants to actually take care of with his wealth. So there's their combinations. Again, you need somebody that knows what they're doing at. We're working on one now in which the dad has a trust for the benefit of his wife and his grandchildren. But he's insuring his kids, so when they die, it's more or less a version of the waterfall. When they die, the money goes to the trust, so it will eventually benefit the kids, right, as well, in a much bigger way than probably the dads and the moms would have left them before that. So it's the dad initiating the process, using their kids as insured persons to get the benefits of the whole structure and enhance the value of the trust. So, and those are live, real cases that we have right now. So again, bespoke is actually an understatement. It's actually made for the benefit, and we've seen so many cases, and the people that we work with in Miami have seen so many cases that it's relatively easy to go in there and with an idea of how you can help them achieve what they want, putting in as little money as they possibly can. So that's basically it.
No, that's good. And so what is kind of the most memorable or unusual experience that you've had in your professional career?
Well, my wife and I we lived in Caracas originally, in Venezuela. That's where we grew up and got married and had our first 3 kids in Caracas. And I was head of a private banking for a Venezuelan bank, probably the best Venezuelan bank in that time, and Banco Venezolano Crédito, and I led the private banking office for them. I was in my early 30s, and at some point they decided to open a broker dealer in the US, and I spoke pretty good English. So they said, why don't you go to the States, open a broker dealer from scratch and get it going, and we'll transfer everything we have in Cayman, again, the jurisdiction issue, over to the broker dealer. So I did that. I mean, it took me, so we were about to buy a house. Bank also gave excellent loans for employees and executives of the bank in Venezuela for their homes in that time. Now it's another story. But at the time, and my wife told me, why don't you call your boss? It was a Saturday. I was about to pay, the what do you call this? I'm not a realtor. My wife's a realtor, but I'm not a realtor. The amount of money you put up just to guarantee that you're getting that house.
The escrow, I think.
The escrow, but there's another name for it. But yeah, the escrow money they're going to put in. I was going to do it on Monday, and my wife on Saturday said, why don't you call your boss? Because if they're going to fire you on Monday and we put this in escrow, we're going to lose, $50,000, right? As a smart woman. I said, sure. So I called my boss, and he said, listen, the board decided yesterday that you are going to be sent to Miami to open a broker dealer. So they'll buy the house here, buy it in Miami. Nobody knows. It's a secret. We'll let it out in about 2 or 3 weeks. But so if you want to talk about funny moments, we were like, okay, so you want to go? I said, it took us like 30 seconds. We said, let's go.
Wow.
We're out. So we left in between 2000 and 2001, and ended up, the whole family was here by mid 2001.
That is
with the 3 kids. So that was it. And it led me to also open a broker dealer from scratch, which was like a paid PhD, because there's even though this was pre 9/11, most of it, the regulations and we had to deal with the NASD. It wasn't even called FINRA then, it was the NASD. and going to Georgia, which in Atlanta they supervise all of Florida, so we had to go to Atlanta and have a full day's meeting with regulators to see if I was qualified to do this, blah blah blah, plus getting the exams and all that good stuff.
Wow.
Series 7, Series 24, getting a staff. That was a fun time, very very active, but I learned a lot, obviously, from all that.
In the lesson, I guess, also listen to your wife too.
Oh, 100%. She's safe. I've had dinners with people that wanted to hire me out somewhere, and when she says he needs you more than you need him, okay, instant red flag. Okay, I'm not going.
That's good. No, that's good. The next question I have here is, what's one piece of advice that you would give someone just starting a career in the family office space? Whether that's as a service or a direct family, what's some advice you would give to somebody?
I mean, even though the model in which banks and large custodians are tending to these large families is going to change eventually because the incentives are not aligned. I've done it, try to push my kids that way, not in the wealth management business because they're into something else. All of them, the 5 of them are into engineering and marketing and Bitcoin, ATMs and stuff like that. So, and they're entrepreneurs as well. But my initial, and they all did it, thank God, is that they worked at a corporate level in order to understand corporate structure and how it's set up. So when you set up on your own, you have some sort of structure in your head of how things should be and shouldn't be, because you see things that are good, things that work, and things that don't work. So getting a corporate exposure, like I worked at this bank in Minnesota, which is great and super structured and very well set up and very well run. But when I worked here in Bank of America, when they stole me from this bank and they said, coming over, Bank of America is a monster, right? So it's like, I said, okay, outstanding. In the end, my recommendation would be not to last too long at the banks, because eventually they sold the portfolio from Bank of America to Santander. So I moved to Santander. I ran the team in Santander. So, but always have, in whatever you do, always try to get some corporate structure in your head and experience, so you know how things work in the real world, because you might think you might be doing it right in your garage or wherever, and you're going to make a ton of mistakes that are basic and you shouldn't make.
Yeah, no, that's good. And, I guess, even outside of the insurance or wealth protection, just learning more about this space. I mean, these families have values and principles that they live by. So my question for you is, what are some of kind of your core values, for you and your family?
I'll say protecting the family name is very important. And that goes into everything, goes into how you behave with others, how do you behave within the family, how people perceive you and outside the family, because it's your name that's ahead of you. That's printed in, when you used to have cards, when what was imprinted in your card, that was it. So protecting the family name, it encompasses, and that's essentially how we have 5 kids from 29 to 17, and that's how we started raising the middle ones, telling the older ones, listen, you cannot screw up in school or anywhere else, because what are they going to say about your brother or sister coming up when they get to that school? Like, oh, you're the brother or the sister of that
That's good.
menace, right? So you have to behave. So the attitude of the teacher or whoever sees you, say, oh, you're Halvorssen, welcome to the school. Your brothers were great. And we try to instill into that. Families in Latin America, I would say that the more discreet they are, the better for us, the more aligned with us they are, because you have to be discreet as well. That's another thing. You're going to be a show off. You're going to have the latest Gucci thing or Fendi thing or a car or whatever. The families that we know that are very, very wealthy and are very, very well run as families and behave well as an entity going forward are very discreet. They're not show-offs. They travel coach if they have to. They don't care. That kind of family, they might have a plane, but if they have to travel coach, it's not like, oh my God. No, they travel coach and they don't think 2 ways. I mean, it's the only way to get there. We'll go coach, no problem. So discreet, I would say, is a very, very discreet in a good way. There's discreet in a bad way, obviously. You want to hide money. Nowadays, you can't hide money from the taxman anywhere in the world. That's not what we're looking for. We're looking for people that are discreet in the way they manage their businesses, and in which it's amazing. If you look up my clients on Google, I've tried, none of them will come
You
up.
won't find them.
I mean, not because they're hidden or they're secret. It's just that they don't
They
say
don't need
anything
to
about
show
what they
off. Yeah.
do. They don't need to show off to anybody, but they're wealthy, right? So that's probably one of the best features that you're looking for in clients, and you choose your clients. Huh?
Yeah.
I've managed through all these jumps between banks that I did at some point in my career. I managed to get rid of clients that I did not want to have, or just imposed on me because of the bank said, okay, here, you have to manage this guy. But life's too short to deal with people that you don't like, right?
Yeah.
So
No, that's good. And then the last question here is, where do you see the family office space headed over the next 5 years, or even speaking to, your space? It doesn't have to be just a family office, but you're working with these families. So where do you, kind of see this over the next 5 years?
yeah, that's a great question. I think the independent advisor, which is what we are, is what families are gravitating towards. And the real independent advisor, meaning the guy that sits with me on the table and helps me and has my interests at heart, because our interests are aligned, right? In our case, we only charge our client for the fees in the asset management and the wealth management business. And as I said, on the insurance side, we're on it. We're basically on top of the product until it basically we're not needed anymore, meaning the policy is going forever and ever, and then that's it. But it's taken care of by the insurance company. So being on their side, being independent, truly independent, you'll be surprised how many independents are out there that charge a retrocession or a fee or get a fee from somewhere else when they sell products. That takes away all your independence and your credibility, right? If you're offering product of any kind to the clients. So I would say independence is key. Family office world is tending towards independence. I don't think I've seen so many family offices fail. I mean, not achieve the goal of setting up a real family office that they thought. They thought they had this office where they had the different players in the office, handling the portfolio, handling the trust, the lawyers, the accountants, everybody there. Essentially, that becomes very, very expensive for the family generally. And so they need third-party providers that can actually tend to not all their needs. Like, for instance, we don't do concierge services of any kind. We don't, pay your rent or pay your credit cards, or that's not what we do. We manage money and we help you with your asset protection going forward. So there are others that do that. But generally, the family office industry has tried to do everything for an office that does everything for everybody. And I think the model is probably going to be people that do certain things like we do well, know what they're doing, have a lot of gray hair, and know how it's been done. And the banks are always going to be there. But as I said earlier, the incentives of the banks vis-a-vis the products that they sell, it's just it's counter to the client. So you find products that are just basically, you can probably replicate that product for your client using a simple brokerage platform. It will cost them 20 times less than the one they're paying the bank in some cases, not all. Banks also have great products, very unique type of niche type products that they have, which is great. That's why we want to see all the banks. So if we need to buy that product, we know we have that bank in your portfolio. We can actually use it to buy that great product that they have. But generally, banks, I think, are going to mutate also. Their wealth management divisions have to change. It's unsustainable. The amount of the lack of alignment, I would say, not the amount, the lack of alignment between the bankers and the clients. Even though they try, they really try. All of us here have managed a group of bankers. I managed a group of 30 bankers at Santander, not 30, it was 28. And you can see that the bank wants you to sell product like any other company wants you to sell product and make the most margin on that product possible, right? That's the business model. So getting that out and that the banks realizing that has to eventually change will happen. I'm sure it's happening now. You can see it.
Yeah, no, you are seeing it with some of these big banks taking more of an advisory, kind of approach.
Correct. Correct. They'll make less money, but they'll keep the client, and they want the assets. And so, but generally, I've seen it. Independence is going to be key. more and more going forward. True independent.
No, that's good. Well, Erik, this has been incredible, and the information here is great. So I know I found value, and I'm sure the audience will as well. So again, just really appreciate your time.
Great, my pleasure. My pleasure. Great talking to you.
And so before we end here, how can people find you or get in touch with you, or if they want to learn more information, what's kind of the best way to do that?
Sure. Oh, I have the name of the company back here. I don't know if it's backwards. I see it backwards. You probably see
No, it looks good. Yeah,
right way forwards. Okay.
Yeah.
So it's Klosters. So it's klosters-capital.com. Our website says nothing of what I have said. We try to be very discreet, as our clients are discreet. We don't try to put bells and whistles. We try to, because each client interaction is going to be different. Each prospect or client or lead is going to be different. So we try to make it, we do this, but klosters-capital.com. And you can find, or put Klosters Capital in your browser, and you'll find us. And we are here in Miami. We're serving families throughout Latin America again, and also in the US. And through our sister cousin company, Klosters Capital in Spain, we also have our European clients in Spain, in a very nice address in Madrid. We're also located here in on Brickell Avenue in Miami, so the financial district. And I would say that that's probably the easiest way to find us.
No, awesome. Well, again, Erik, thank you again. Really appreciate your time.
My pleasure. Thank you very much for your time too.